Okay, E10 says on January 1st, 2013, Innovation Solutions, Inc. issued $200,000 in bonds at face value. The bonds have a stated interest rate at 6%. The bonds mature in 10 years, pay interest once per year on December 31st. Prepare the journal entry to record the bond issuance. Right, the first thing we have to do is determine how much the bonds received for cash, how much cash proceeds we received for the bond. It tells us the bonds issued at face value, which means they issued for that amount printed on the actual bond itself. So when we do the journal entry, we debit cash, which is an asset, increasing the asset. And in this circumstance, it's face value. We debit cash for face value because the market rate and the stated rate were equal, and the amount of bonds that we have here is 200,000. We credit bonds payable for the same 200,000. Now, in both of these problems with E10-7 and E10-8 that we've been dealing with here, the bonds were issued at face value. That is not always the case. The bonds can be issued for a discount or a premium, which we'll deal with when we get to E10-15. So I want to make you aware that if it did issue at a discount, you would debit cash for a lesser amount. Your cash proceeds would be a lesser amount than face value, and you would debit discount bonds payable for the difference between the bonds payable and then the actual cash proceeds, which would be a lesser amount. And if it was a premium, it'd be the opposite. So if it was a premium, you would have received more cash than what was on face value. Therefore, you would have debited cash for a higher amount than face value, credited premium on bonds payable for the difference between the cash and the bonds payable, because bonds payable is always face value. Whenever you establish bonds payable for, it's always going to be face value, no matter if the bond issues at a discount or a premium. On part 2, it says, prepare the journal entry to record the interest payment on December 31st, 2013. Assume no interest has been accrued earlier in the year. Well, they tell us that we have a stated interest rate of 6% and that the bonds were issued on January 1st, 2013. Stated interest rate at 6%, multiply the 200 out times 6%, we're getting $12,000, or we're paying $12,000. We debit interest expense, $12,000. Credit cash, $12,000, because it tells us that we pay interest upon December 31st. Again, important thing to remember, sometimes students get hung up on situations where they're not for sure if they're in the circumstance of receiving cash or paying cash. When you have a receivable, you're earning interest, right? You get interest because you let someone else borrow your money. You've established a receivable because someone else owes you cash. Okay? When you have a payable, you're paying interest. You've borrowed money from someone and now you owe them back the principal plus the interest, okay? This is bonds payable. This is a liability. You are basically paying rent to rent someone else's cash. Does that make sense? That's kind of what your interest is representing, so to speak, a rent on that cash. So, debit interest expense, which increases expenses, decreases stockholders' equity, credit cash for $12,000. On part 3, it tells us that assume the bonds were retired immediately after the year for the first interest payment at a quoted price of 101. Prepare the journal entry to record the retirement of the bonds. Well, when we look at this, we are retiring the bond for an amount that's greater than what it was when we bought it for, right? We're retiring the bond for an amount that's greater than what we bought it for. Why? Well, the market's always fluctuating. If you want to retire your bond, you essentially have to go back and purchase it on the open market. So now the price is different. Now it's at 202, and we need to get rid of the bond because we're removing that liability. So we debit bonds payable, which is a liability, so we debit it to decrease it. The $200,000, because that was the full amount in the bond. We credit cash because it's going to cost us $202 to get rid of that bond. So we credit cash $202,000. But now our journal entries don't balance. The remainder left on the debit side is going to go to loss on retirement. I'm just going to call it a loss account. Loss on bond retirement, something like that. It would be $2,000. Now our journal entries balance. You can think of a loss sort of like an expense. It's not exactly an expense in a sense that it's not a cash outflow. And expenses aren't necessarily a cash outflow because they can differ in their timings. But losses, they will never generate future income. You might incur an expense that might later on generate some sort of future benefit. But losses, they are essentially something you already incurred and will never generate something for you in the future. Okay? But they do decrease net income, so they decrease stockholders' equity, and they're like expenses in that respect. Okay? All right, so this is your journal entry on retirement. Remember, if you retire early, you essentially have to buy it back on the open market. If you have any questions on E10-8, please feel free to let me know.